Hello folks, so you're once again welcome back to my channel. Today is going to be a very quick one and a quick review of what's happening on volatility 75 and volatility 100. So these are synthetic pairs, and as you all know, synthetic indexes are not really affected. They are not necessarily really, they are not affected by news. All right, so last Friday was the first Friday of the month, which was non-farm payroll, and then you also the movement on other currency pairs. All right, so today we are basically looking at volatility 75. As I have always been analyzing on my previous videos, you know, I always come with a different light. I look at the market in a different light using different tool of analysis taught by my mentor Michael Henderson. All right, so I want to quickly go into today's video, and then we'll take it from here. All right, so we're on the monthly time frame, and we saw the movement this market did here. Came down and then flashed up, and then it broke down, and then we all see what is trending now, you know. So as you can see, when we are looking at I saw something that I had to draw your attention to on the market with regards to breakers. Okay, with regards to the market breakers. All right, so look at this line. This is just an add-on. This is not basically the main thing today, but this is just an addendum to the videos I did previously on breakers. All right, so look at this. Can you see this price point? So you know, with breakers we have price point A, B, then the swing before the breakdown, then we come back to retest the point B. So we have price point A here. Let me increase the parameters, sorry. Price point A at this level. Okay, we have A here, and then we have price point B. Where is that? The low. Price point B. All right. Okay, so where is it, this or is this? Don't get confused. The lower point forms the B. So A, B, then C, we have the breakdown, then a retest into point B. So the point B becomes the last bearish candle that drops before the bullish movement upwards. Okay, in a way you can still consider this last bearish drop here before, but in another sense you can equally consider, when you have movement like this, you can consider the last bearish drop before that swing low that formed the high. So all these other ones are still captured within the swing up. All right, within that swing up. Okay, beautifully has been formed here. All right, so now let's look at something here. So from point A to point B to point C, then we break down below this. We break down below point B. Then what's next? We expect, so we break down below point B, so we expect a reversal back into our breaker. Okay, so this forms the breaker. So beautifully, let me just look at this whole area here in perspective. so beautifully into our breaker. All right, now let me use fib to show you something beautifully here. For those of you who are fans and fanatics of fib levels, when I pull the fib, can you see? Sorry, let me go this way for you to see well. Can you see where the fib price got to actually effect the reversal? It traded, number one, into a proportion block. Number two, it traded into a breaker. You get it? So it's in a way acting as a proportion block is an order block, stemming from a first order block to form the second order block. So it's a proportion block. All right. So there's an order block here, it's another block here, and beautifully this is a third order block, okay, formed here. So you could see that when price traded into it, it also rallied away from it. All right, so now let's not look at that. I wanted to draw your attention to the fact that price traded into the breaker, and then beautifully we saw the reversal. All right. Okay, so price traded into this breaker, and then we saw the reversal. So this is what I actually wanted to draw your attention to with the breakers. Okay, now beside that, let's continue. What I wanted to show you today is this, that price trades in ranges. Price trade in ranges. Okay, price trade with range. So now, if you are going to trade with ranges, what do you have to consider? What you usually consider is simple. So, for instance, we have price trading this way, upward here. What you have to first do when you want to look at the range that price is looking at going to take is this. First of all, you have to count back 3 months from the current month that price is trading. This is a monthly time frame candle. So price is currently trading 3 months from now is first month, second month, and let's say this is the third month. All right, beautiful. So when you identify 3 months away from the current month, what you have to do is, now if it is bullish candle, what you do is that you draw a line below it, just at the bottom of the body. First of all, just at the bottom of the body of the candle, just at the bottom of the body of the candle. Then you identify the lower point of the candle as well. So now we have the body, we have the candle. Now, anytime you identify this, if it is a bullish candle, you put the price lines below it, the body and the wick, the lower point of that trading or that price action. All right. So we have identified this. Then what next? The next thing we do is we try to go back into time. But before going back into time, we have to ensure that price has traded below the lower point of that particular candle. If price has not traded below the lower point of the identified candle, we cannot consider that candle and use it to determine our range. Because when we do that, the price doesn't form the order block that we are looking for. So here, price must trade below it to have it form or become that in a form of an order block. So for instance, if you have price trading below it with the body trading below and resting below it this way, you could say that, okay, we have price trading below this particular price point. So you may call this particular candle an order block. Okay, so if price trades below it this way, what we do is that we go back into time. to find out the bearish price point or the bearish highest point which price has not traded into. So when we come back into time, here the bearish price point that we can find that price has not traded into or has not reached is this level. So you may say that the range for the particular current price point is from this point to all the way down here. This is the range that price would seek to achieve. It is not so simple that way. Now, because price has not taken down this price point, you cannot define the range with this particular price point, which is 3 months from the current month. So this is not valid. But on the price point where you find this, then the setup that I just described is valid. Then you use, based on that, you use it to determine your bias for the days. Now, assuming the other way too is the opposite of this is the other way. So for instance, if we're trading in this particular month here, so assuming we're trading in this particular month, okay, so you're trading in this particular month. So 3 months back is this, this, and this. So we now rest on the bearish candle here. So what do we do? Here we take candle on the body, and then we take price on top of the wick. What do we do? If price trades above it with the body of the candles, what do? We go back into time to a price point, a bullish price point where it doesn't touch this particular price level. So this would have been the price point. So now the range would have been from this particular price point all the way down here. Do you get it? So this would have been the range, and price closes in. But here we didn't have price, the body of the candle closing above it. So we couldn't consider this as our range. In a way, price still closed in on that range. So that is one way to determine ranges, but this is on a higher time frame. This is on a higher time frame. So now let's go down to one weekly time frame. All these one that I'm just adding, they are just add-ons to what I basically, the review or the updates I want to give you on what is actually trending on the daily basis and what to expect. All right, so this is just an add-on. So let's go down to our weekly time frame. But nonetheless, price currently is accumulating, so we have accumulation phase, we have manipulation phase, and then we have the distribution. So currently, what do you see? Even on the bigger picture, what do you see? You can see clearly this fair value gap. Price traded into this, the mean threshold of this fair value gap. Necessarily, what do you expect? You usually want to expect that price will close in on the fair value gap up here. All right, then whatever movement comes with it, you take it like that. All right, as price has traded, as this bullish candle has traded into the breaker, we consider this particular price point to also become a bearish order block. Okay, this particular price point also becomes a bearish order block, and then there's a fair value gap here which price has traded a little bit into the mean threshold of it. What necessarily must you expect? The price will definitely close in on the full order block, closing on the full side of the fair value gap. So this is a sell side imbalance and a buy side inefficiency. Okay, so the inefficient side is the buy side. We are expecting price to rally up, close in, but it doesn't just happen with a twinkle of an eye. It takes much more into that before price goes up to close in on this particular gap. Okay, so if price should price come up and trade above this price point, these two price points, necessarily we are coming to close in, and our target should be on this high. If price should close in above this, the next target is closing up above this high, and then probably closing in on this fair value gap, which also should be the mean threshold of this order block. All right. Okay, so beautifully, let's continue to our weekly time frame. All right, so on the weekly time frame, what are we seeing? The last time when I explained, the last lecture that I explained, I told you that I saw this area as a rejection block, and I was expecting that price shouldn't break below this. Okay, yes, so price traded into this area, and you could see the rally away from. This is just, today is Tuesday, and we want to see what actually will transpire on the market. So price traded slightly into the rejection area, and then you can see price rallying back up. All right, so price actually came down and couldn't take sweep below this low. All that it did was it swept the liquidity resting below this price point, and then it rallied up, but not below this price point. Okay, so nice, beautifully on the weekly time frame, this is what we are seeing. Price coming into the rejection area, and then it has been rejected and is moving up into the sky. All right, now let's see our target. Should price trade above this high, our target should be price coming to take down this high, and then it will rally up. But here on the weekly time frame, we have this beautiful order block resting here, which actually rejected price to all these levels. Okay, rejected price to all these levels. So you could see that price actually traded into the mean threshold of the order block, and then not just the mean threshold of that order block, it was also at the bottom of the monthly liquidity void. So let's go to the monthly fair value gap. Okay, let me put the annotations there so that you see them well. Monthly FVG. Okay, now down to our weekly time frame. Okay, so we have this order block resting here, price traded into, and then we saw the rejection down. Price has also traded into this area, and we could see price doing its thing. What do we expect? Let's see if price trades into the order block. Let's see the reaction that price takes. That's why I'm saying that I'm hoping that if price should sweep the high below this and close in on this particular price point, then we will expect a change in directions, and then we'll see how we'll take our trades. All right, okay, so beautifully, this was the rejection area that I told you about, and I'm seeing price being rejected and moving up higher. All right, so beautifully, this is what we are seeing. Okay, and then this is the weekly OB. All right, now what should we say is happening even around this area? On a bigger picture, you can also say that you can see more of accumulation happening here. So we would want to see the manipulation, and then we'll see the redistribution. Okay, so we could see that price is accumulating more orders in this area. So there's more sweeping of highs and lows inside this area. Okay, sweeping of highs and lows, there will be sweeping of highs and lows. Then we'll see the redistribution, the manipulation, and then the redistribution. All right, let's go down to our daily time frame and see. So today my bias was a bullish day, and nonetheless it happened the way I expected. So my bias was bullish because I was expecting price to close in on this small fair value gap resting inside this area, and price actually couldn't close in fully. So I was expecting that price should close in fully on the fair value gap, and lo and behold, it ran through the fair value gap, and this is where we are now. You see, beside the fact that it ran through this fair value gap, I'm seeing this even as a daily order block that price has also run into, because of the fair value gap resting just below this particular price point. So I want to see the reaction of, or the closing of today's candle, and I'll just give it tomorrow. If tomorrow price, I'll look at it on a smaller time frame. If I get the bearish movement, I'll give it a shot, because now it has also left another fair value gap resting below this area. Okay, now we are not saying that every fair value gap should be filled. You get me? We are not saying that every fair value gap should be filled, but now let's see what transpires tomorrow. Let's see what transpires tomorrow. Now let's look at the smaller time frame to give us more picture of what we should even expect. So let's put annotations here so that we don't miss everything like that. So FVG, this is daily. Okay, so this is FVG on a daily time frame. Okay, and then we have, sorry, let me put it well, and then we have sorry, we have the other block resting inside this area. Okay, we have the other block. So it's a bearish OB. Why do I consider it as another block? Beautifully, other blocks, you see some fair value gap resting just before the candle, and then it beautifully presents itself. So now look at this other block. Where is the mean threshold of the other block? Beautifully here. Let me not use this. Let me put this here. Beautifully, you could see that this is the mean threshold of the other block, and you could see that price traded almost into the mean threshold. And then what are we expecting? What are we seeing? What are we seeing? We are seeing price not even closing above the mean threshold, and then we see this kind of movement. So let's see how price closes, and this is not the right time to execute trade. So those who want to execute trade, if you want to execute trade now, what necessarily must you do? You can, if you want to execute your trade, you can execute your trade here. Put your stop above this. Aim for the closing on this fair value gap here. It should be a fair deal. You can place a trade here, your stop high on this high, and then aim for the closing on this gap. All right. Okay. So beautifully, that is what happens on the daily time frame. Now let's look at the smaller time frame, which is the 4-hour time frame. This area was an area of a daily fair value gap, and on the 4-hour time frame, you could see that price traded into this area, closed in here, and then it dropped, and then we are having this sort of movement. So there was some long movement here, which was the area where we have to consider it as a liquidity void. You know, price just rallied in this, within this range. And one thing that I saw in this range is that anytime you have price rallying into a long range, expect price to reverse at least into the mean of that range. So look at it from this price point to this particular price point. What do you see price did? Price reversed into the mean of the range. Okay, so anytime you have price, rallying on a very high speed, like a top speed, maybe you look at if it meets any of the PDRs, expect that price is going to really reverse back into the mean before it does concludes all the movement that it has to do. Then you see your way out of it. All right. So beautifully, price has closed in on this fair value gap here. You can see that the body of the candle has just wicked into it, you know, which is not a sign of any form of reversal any moment soon though. All right, so basically that's it for the 4-hour time frame. And what are we seeing here? We saw the price traded from this high to this point to this high, and now price traded up here. So could you have identified a breaker if you were trading on this around this area? Could you have identified a breaker? Beautifully, you could have identified a breaker, you know. So for instance, this would have been a breaker for you today. This would have been the breaker for you to have traded. Sorry, my colors are a little, they are too deep. I have to minimize or tone down the colors, you know. Let me tone down the colors. Can you see that? So this is my breaker today. This is your breaker. So price trades up this way, and then what did it do? Traded back into it, and then close above it, traded back into the breaker, reversed up. Look at it. When price came this point, when it opened, it just dropped into the breaker, and then boom, it just went off the breaker. See, beautifully, that is it. Beautifully, that is it. Look at it on the 2-hour time frame. This is H4. Let's look at H2. Let's look at our price on H2. You see, the last bullish movement before the drop, price trades into, you see, when it is continuous like that, you consider the last bullish candle up here, price trade deeper into it, and look at how the bodies were just resting below it, and then it moves. Price is not usually supposed to break below it, you know, but this is it, and then price rallies up. So today, if you were in this day, today being today, if you were trading, if you were supposed to have taken a trade today, knowing your bias for the day that price was going to close in on this fair value gap, price opens below it, price trades down into this area, closing in on this breaker, necessarily what you could have done was just execute it, because see, as it's even close in on this fair value gap into the main threshold of this fair value gap, to the main threshold of this fair value gap, it would have been a good entry. All right, let's still go down to our 1-hour time frame to give us a more refined, if we had taken a trade today, a more refined entry. If you're supposed to have taken a trade today, a more refined entry for the day would have been what? So price traded into slightly into this fair value gap, dropped and closed at this point. Price traded up, and then someone asked me, does price on synthetic index respect time, New York sessions? And I said yes, it does. Yes, it does. Yes, it does. So you see a drop here. Price dropped this candle, and then price had to close in above this. So look at what it does. What it did here. It ran below the low of the previous night. And what did it do? It rested here. So now it formed this particular, you may consider it, you may not say, you may say, oh, this can't be an order block and all that. Let's look at it on the smaller time frame. It will give you a clear picture if it was an order block on a smaller time frame or not. Okay, if it was a, let me try and minimize the size of the line. Okay, so now let's look at it on the smaller time frame, 30 minutes time frame. Beautifully, when price traded and sat into this, look at what it did. Closed in below this, and look at this particular price point. You may not consider this long candle as another block. Let's look at it on a 15 minutes time frame. I want the video to be as quick as possible. So look at this. Look at this. This is what we call turtle soup setup. So if at this time of the day, let's look at the time of the day that price did this. Can you see 9 a.m. 9 a.m. in the morning? 9 a.m. in the morning. Price had to dip turtle soup dipped below the low that it formed in the early hours of the day. Quickly, we should tell us that. So this all this price point, you see, from the time price opened, you could have easily seen that price was actually consolidating. There was a lot of consolidation here. Look at it well. There was some sort of consolidation. So you put it to the highest point on the early morning session. Okay, early morning session. This point, from this price point, what time was that? That was around 1:30, and then you close in on the low point of the morning session. And then what happens in the afternoon session? Prior to the afternoon session, from 9, 10, 11, what happened? There was a sweep quickly, and then there was a rally up. If you had not even caught the trade here, as price swept this low and then rallied up and closed above this morning session, look at what price did here. It came in and then to sit right on top of the session high, the morning session high. Price came to close in on the fair value gap that is resting just before the rally up above that session. And what is it? There's this small opening here, and then another rally up, closing in above. So you could see how price even responded in the fair value gap. When price traded into the fair value gap, you could see the movement. Price really didn't want to trade away or outside of the fair value gap, and these signs are clear signs of price going to close in on the fair value gap to rally away from the fair value gap. All right, so beautifully, if you had even taken a trade from this point and closed it here, it's a good deal. All right, so basically that is it for volatility 75 this evening. So hopefully, let's see what happens tomorrow, and then we'll know our way forward. So as I told you, you could on a daily time frame, you can see that this is the old bearish order block on the daily time frame. Price has closing on this fair value gap, traded here almost into the mean threshold, and you could see the slight rejection, you know. So what's next? What can you see? So should price close in above this fair value gap, I'm looking at these highs. I'm looking at these equal highs resting here. I'm looking at these equal highs resting here. Should price take down these highs, I'm looking beyond even that to this particular price point. To this particular price point. Okay, to this particular price point. So all you need to do is just patience. So someone asked whether you can take a sell trade now. I said if you want to take a sell trade, it's no problem. If you take your sell trade within this area, put your stops above these highs and then see where next price will likely draw. But you should always know that price is seeking for liquidity. Where is liquidity resting? I can see beautifully this equal highs resting above here. That is a clean high that price should necessarily breach this block here and then sweep. Price is always seeking for liquidity. All right, so guys, this is where I'll leave you for volatility 75. I'm going to put the next video for volatility 100. If you are new to this channel, please subscribe to my channel and then stick with me here for more of these videos. If you like my videos, please share for others to also. I want to grow this channel. By the end of this month, I want this channel to grow and cross 500 subscribers. I want to just share for a lot of people to subscribe. So help me grow the channel. Let a lot of people subscribe. Recommend videos to your friends to also watch. Friends who are trading volatility 75 index and all the volatility pairs, synthetic volatility pairs, they should subscribe to my channel because I have more stuff for you guys. All right, I wish you all the best. Have the best of the day and then enjoy the rest of the day. Stay blessed.